Hi there, my name is Nhyira Premium and welcome to the Business Lecturer in Within Show, where we are looking at the various accounting standards that we need to understand for financial reporting and corporate reporting towards our examination. Now, in this series of financial or accounting standards, I'm taking you through the fundamentals, the principles, and the core ideas that you need to understand on various accounting standards. And so what I would want you to do is to follow me on Instagram, because I release these videos. You like my page on Facebook, I release other videos also there, and then you can get access to these videos and download them also on my YouTube channel. I'll get the audio version of all of these lectures also on SoundCloud. On all these platforms you can find me on at Nhyira Premium. So if you make sure that you subscribe, you follow, and you like, and then let's keep connected. Remember, if you have any questions about anything that I've covered previously or anything that I'm yet to cover, feel free, you can put it in the comments box, and then I'll read that, and who knows, in the next video I will be answering your question for you and help you to be able to understand and prepare well for the examination. So in the previous video we were looking at IFRS 15, revenue from contract with customers. Now we saw in the first video the recognition or the conditions that must be satisfied before we recognize a contract with a customer. Then from there we came to the second aspect, where we said that we need to look at the issue in relation to the performance obligations that we need to undertake, right? Then from there we came to the issue about determination of the transaction price, and then in the just ended video we saw that we need to look at how we allocate the transaction price, and I illustrated it on the board here. So I want to go over that again so that we do the fifth one, and that will be all for this accounting standard. Now, so what we are looking at is that we said that in the fourth stage, or in the fourth step, what we need to look at is we allocate the transaction price to each performance obligation using their standalone price. We allocate the transaction price to each performance obligation using the standalone price. So what do we mean? I gave an illustration that, for instance, if you are coming to me that I should teach you for 2 months, then I am charging you $1,500. That means the transaction price is $1,500. So what happens then is that I need to find out what is the performance obligation, the various activities that I'm going to be undertaking under this contract. And so we agreed that under this contract I'm going to be teaching you, I'm going to be giving you books, and I'll assist you also when you are doing your registration. So these three are the performance obligations under the contract that we have agreed on. Then I mentioned also that the standalone price simply means how much that each service or each performance obligation could be sold for separately. So if I was teaching somebody in 2 months, I would charge the person $1,000. If I were providing the person with books, I would charge the person $700, and if I'm assisting someone separately for just examination, I would charge the person $300. So these are the standalone prices. So we said that we use the standalone prices in order to allocate what the transaction price. So as you can see on the board here, you realize that these are the standalone prices. When you sum it up, it gives us $2,000. Our transaction price is $1,500. So if we do 1,000 over 2,000 times the 1,500, which is the transaction price, we're going to get $750. Then we do for the books 700 over 2,000 times 1,005, we get $525. Then we do for the registration 300 over 2,000 times 1,005, we get $225. So as you can see, when we add these three up, okay, it should give us what? The 1,500. So what have we done? We have proportionally shared the transaction price among the performance obligations that we are going to be undertaking using their standalone prices. So after we do this, then we now come to the fifth step. Alright, we now come to the fifth step. Now, so what is the fifth step? The fifth step is you recognize revenue when or as the entity satisfy a performance obligation. You recognize revenue if or as an entity satisfy a performance obligation. What does that mean? It means that We will only say we have a revenue when we have actually undertaken or performed a certain performance obligation. So what does that mean? I am teaching you for 2 months. So for instance, I may prorate this 750 into 2 months, all right? So I divide that by 2. So 750 divided by 2, let's see what we get for that. That should give us $375. Hope you can see that. $375. So that is per month that I'm going to charge. So what does that mean? Recognized revenue as and when performance obligation is met or satisfied. What does that mean? It means that when I teach you for the first month, it means when you pay me the money today, I cannot recognize 750 cedis as revenue. But at the end of the first month, then I can recognize 375 as the revenue for that month. Then maybe when we sign the contract, at that very moment, I'm going to give you the books. So when I give you the books, then I'm going to recognize 525 as what? My revenue. Then you could realize that this registration thing 225, it's going to be taking what? A long time. It is after the 2 months when I actually help you to do the registration that I'm going to be recognizing what? That revenue. So this is what you need to understand when it comes to using the IFRS 15 in order to recognize revenue. So remember, we are allocating the transaction price to the various performance obligation using their standalone prices. Then the fifth thing is we recognize revenue as and when a performance obligation is undertaken or is satisfied. So when I give you the books, I recognize 525 as revenue. When I teach you for the first month, because we are dividing that by monthly basis, so at the end of the first month, then I can recognize what the revenue, meaning that all the revenue that we've received, if you paid me the $1,500 in cash, it's going to be it will be in a deferred income account that we're going to be transferring as and when the performance obligation is satisfied. So that is what you need to understand. So for double entry purposes, what are some of the things that we need to do? For instance, if we receive this 1,500 at the signing of the contract, boom, what do? We can debit our cash book. That is if we receive the money, right? But if we didn't receive the money, but the contract has been identified, we can debit the receivables account, okay, without the 1,500. And then we can credit revenue deferred accounts. Okay? We're not recognizing it yet. It's deferred accounts. Then as and when a performance obligation is undertaken, we will debit this account and then we will credit our sales or revenue account for the year. So this is what you need to understand about IFRS 15. Now remember, get to my YouTube channel. If you're already watching this on YouTube, just look in through the playlist and look at the video on IFRS 15. I solved a full question on IFRS 15 on how you can actually recognize revenue after you undertake this calculation. With this ones, with these short videos, we are just looking at the principles and the concepts well. So you can go on YouTube, check that video out. It's a full lecture video that I solve questions on the IFRS 15. So these are the things you need to understand. Remember to subscribe to my YouTube channel, follow me on Instagram, like my page on Facebook, and follow me on SoundCloud. If you have any questions also, put it in the comments box and I will be covering that in my next video. So I'll see you in the next video as we talk about other forms of accounting standards or other types of accounting standards.